Debt. And worst cases, you produce nothing. You borrowed money for absolutely no reason. That's the worst kind of unproductive debt. Or you somehow lost money. So you owe more money. It increased your debt on top of that. So this is kind of what the United States has more or less been engaging with, a ton of unproductive debt. And how do we know that? Well, empirically, yes.
My question is, and the audience might be wondering this as well, and I kind of have like an intuition about the answer to this, but do student loans, the conundrum with student loans, do they play into this as well?
Yeah. So basically, in order to really think about that, you have to map out the student loan or the cost of debt and the servicing of that debt relative to the income of said degree. So then you can then evaluate whether or not it's an unproductive debt, or whether the value or the delta between the debt incurred and the benefit, the economic benefit incurred, is widening, right? So, or narrowing. In a worst case, we're narrowing or widening. So yeah, that's how you can kind of evaluate that. And I see where you're going with that. And yeah, probably it got worse. It got worse over time. And that has to do with kind of like the indebtedness of the entire Western world. So everyone's taking on debt right now. Societies have done this in the past, but anyway, so the current system does not coordinate fiscal and monetary policy. And so a lot of that is, so again, I mentioned fiscal and monetary policy. For those who may not know, fiscal policy is the government spending, monetary policy is the Federal Reserve. So what Dr. Lacy-Hunt emphasized is when the government share increases, the private share decreases. And then government share has a negative multiplier. What I mean by government share is government share of the economy. Government share of the economy, private share of the economy. So government share, this is very important, government share has a negative multiplier. Private has a positive multiplier, negative multiplier. And this is in reference to the velocity of money, that we talked about before. So I want to take a look right now at graph number 2. Graph number 2 compares the United States, the Euro area, and Japan. So what we can see from here is basically the law of diminishing returns plays a huge factor in this example. So the United States, the Euro area, and Japan have seen diminishing returns from their increasing debt over time, and this kind of makes sense. So an example you could take is Austin moves out, right? He's making some money. He moves out of his home. And he goes out with this money and he starts to buy all this furniture, right? He starts to buy all this furniture. Let's say he's making $1 million a year. He's balling, right? So then he goes out and he borrows a lot of money to buy a car. He borrows $200,000 to buy a car. He borrows whatever to buy a house. So in the beginning, he's actually contributing quite a bit. And the debt is actually contributing a lot to his life. He's getting a car, he's getting a house, he's getting furniture. So let's say he's going on a borrowing spree. So again, in the beginning, he's feeling these effects, but over time, his debt burden is going to increase. And in fact, he's going to feel less of the effects and he's going to have more of a crunch. So over time, he's going to experience what the US and Japan and the Euro area experience. The excess debt becomes a burden on his growth potential. And now he goes to the bank and he wants to borrow more money to buy assets or whatever. And he can't because he has to service the existing debt. So it actually can be a hindrance if done in unproductive ways. Again, going back to the unproductive debt. And before I forgot to mention this because I answered your question, or we were going over your question, was how do you know it's been unproductive debt? Well, the way you know is simply the growth rate. Very simple for you to observe this. If you see productive debt, you should see debt going up and the economy seeing a net positive because of the debt in greater proportion to the debt incurred. Is that the case? Well, if you look at the data, no. How do you know that? The debt has been growing faster than the economy. Ergo, mathematically speaking, you have proven the existence of unproductive debt. Unproductive debt is there. And how do we know that again? You see that the debt grows faster than the economy. Quite simple. That's a simple way of doing it. It's not telling you how much of it is unproductive debt. That's a separate, much more complicated analysis that you'll have to do, stuff that's probably not in our pay grade and not stuff we're not in positions to do. But you can see that its existence is within the system by making that observation. So one other graph I want to go over is kind of important. It actually just compares, let me see right here, got it right here. So the ratio, this is the ratio per capita GDP for the Euro and US, Japan. So the United States, we can compare it to Japan. And can you see my mouse here, Austin?
Yes.
Perfect. So in United States and Japan had a comparison of 7% lower than Japan because it's on a per capita basis because everyone has different populations. So you have to do it per capita because on an absolute basis, the United States was larger than Japan. But on a per capita basis, the United States was 7% lower than Japan in 1995. Remember that Japan was riddled with debt, okay, at this time. And it only gotten worse, right? United States was not that bad. Europe was worse. Okay, so Europe on average was worse. And you see that United States was 23% higher than Europe in 1995. Well, fast forward to today, now the United States is higher than Japan, right? So it got worse by a factor of 20% because you had to normalize and equalize, and then the United States surpassed Japan by 13%. So Japan got a net negative, right? It got worse. The comparison between the United States and Japan got worse. The comparison between the United States and Europe got worse. And it's only trending faster in this direction. This is actually very troubling. This is what the deflationist, or Dr. Lacy Hunt in particular, is pointing to as a huge problem. There should be a big red flag. And why does this matter? Because your investments, you should cater them and think about the jurisdictions in which your investments are in. This is very important because you want as many tailwinds as possible. You're about to say something, Austin?
No, I'm just absorbing. I'm absorbing all of this.
So
this is kind of your show right now.
So the debt can resolve in a couple ways, but I'll actually go over some. The McKinsey Institute has a good study that based research on, I think it was 23 developed nations, 23 developed economies, and came to certain conclusions as to how governments should basically induce themselves. And a lot of it is debt is resolved in one of three ways. So basically the debt is taken on by the private sector and resolved in that way. So the private sector takes on the debt and resolves it. So basically, in other words, the economy grows faster than the debt at one point, and it absorbs the debt and is able to extinguish it. The other one is austerity. And Austin, I told you that there'll be a treat for you because you're a World War II fan. We're going to dispel a myth here in the deflationist argument about World War II. So
this could be
a lot of people, and this is the deflationist argument, a lot of people would say that World War II, the war itself, is what got the United States out of the war. Well, the data, according
that's what got the United States out of the
I'm
recession.
Sorry, out of the recession. Yeah, the war did not get us out of the war. Misspoke there. But that World War II got us out of the war because it encouraged production, et cetera, et cetera, et cetera. A lot of Keynesians believe that. So World War II actually was a point of austerity. Yes. So this is actually from the McKinsey Institute, and a lot of extensive studies that have been done on terms of what the effects were during World War II. This is not the historian perspective. This is more the economics perspective. All right. So essentially, during World War II, it's a really good example of austerity, and a lot of people don't think that because they think that we had a lot of huge government deficit. We did. However, so at the moment, the government debt was only 14% of GDP, and the private savings was 26% of GDP, which gave us a national net debt savings of 12 to 16%, around there. It was between 10 and 14%, but around 12% GDP. So that is the definition of austerity. Austerity defining that you have a positive net debt national savings. Definition of austerity. And McKinsey Institute, the study concluded that austerity is one of the primary reasons as to why you'll experience growth in the future, because true growth comes from savings. And actually, that's where the deflationists agree with the inflationists. They agree on that. So it's
another point of agreement.
Yeah, it's another point of agreement between the different kinds of economists. True growth comes from savings. Savings, accumulated savings over time, leads to growth in the future because savings is just future spending. right? Futures, current spending or current debt taking is expensing future earnings. So those future earnings must go as towards those liabilities, right? They must go towards servicing those liabilities. And again, we didn't get into the debt-based system that we're in and like the core mechanics of it, because that's for, I guess, for another video, but that has a lot to do with it as well. All right, so I said there were three ways. One of them was austerity. The debt was burnt, the debt was absorbed. And then the last one is the worst one, default. All right, default is the worst one. So default is where the deflationist argument actually turns into, no, yeah, there will be hyperinflation. So the deflationists would say, if the United States were to, you know, say, hey, yeah, we're not going to pay it back. Well, all of that money that is accumulated in terms of debt would suddenly hit you like a rock, so to speak. And you would have one form or another of hyperinflation. Now, that others would say the United States specifically will not default on its debt. Okay, but those are the three ways that we kind of covered as to how debt is resolved or excessive debt is resolved. So this is another point of fact. So investment, not including financial investment, because it's very important. So we're talking about real investment into PP&E, stuff like that, productive assets, not financial investments, so not stock market related. Okay, it's not financial instruments. In 1929 was 6.3% of net national income. Right, and then this trend continued for a long time in the United States. But today it has trended down to 2%. So it is about 1/3 of where it was before.
Okay. And we all know how bad that crash of 29 was too.
But the investment was still 6.3%. Because investment is future gain. Investment. Yeah. And investment was 6.3% of net national income. Net national income. So this is kind of where we're going with this, is basically the conclusion from this point is that more spending reduces the net national savings or net national income, you know. And then because of this, large infrastructure bills, large infrastructure packages, hint why I'm mentioning this, will not have long-term benefits, will not have sustained long-term benefits. And basically, I'll make this point here, and we'll see in 10 years if that point holds true, right? So we're going to see a huge package, right? We just saw a huge package pass. If this is true, based on historical data, based on the studies, you will not see an economic benefit. In fact, we'll go over why it may have the counter effect. But again, government to savings, when government to savings is very large, this savings is very large. So basically spending money you don't have. The savings is future spending, borrowing is future pay down. Okay. Savings is future spending. Remember that savings, when you save, it's future spending, but borrowing to pay your bills is basically you're taking away from your future. You're borrowing from your future, right? You're borrowing from future spending. So it's one or the other. So you're saving now to spend later, or you're borrowing and spending now to then not spend later, right? To pay down debt later, unless you're going the default route. If you're going the default route, then you know it's different. But that's more or less what you kind of think about. So investment has actually been going down, and because you're having this effect of the percent net national income or net national savings, as you actually increase spending and from income sources you do not have, the deflationists will say this will lower it, and they point to the entire past 20 years as it's been trending down. And I'll show again more graphs, and I'm actually going to show them right now. So we have, let's pull up the graph number 4. So graph number 4 is the money multiplier. We kind of saw this with the other one, but this is kind of like a little more detail. So you can see here from the 50s, you see a greater time horizon. 50s, each of these are recessions. Okay. Each of those colors are recessions. So right here, what happened is the alleviation of the reserve requirement, and it had a momentary increase, but then it's going back down. Not a good sign. Okay, so we don't want to see that, but we are seeing that. So momentary a release of the reserve requirements by a little bit, and it went down. So in the textbooks, they teach you something that the money multiplier has an effect with the reserve requirements in equal proportion, but that's not necessarily the case, and this kind of proves it. Okay, because in theory, you should have like if the reserve requirement of 10, you should have multi-multiplier of 10, but that's not what occurs. Okay, so you can see here, since the financial crisis, our money multiplier is actually flatline. Well, not flatline, crashed to the floor. That's not a good thing by the standards of most economists today, because the money multiplier is, again, how many times money exchanges hands. So something is wrong, and no one knows what it is. In power, no one knows what it is. Right? The deflationists will tell you this is what's happening, and this is the observations we're making. This is why you're seeing anemic growth. These are the problems that will begin to accumulate over time. So they're pointing this out to you. And these are the arguments they're making in terms of why we saw such little growth over time. And again, you might have heard that the growth rate, the economic growth rate, if you remember the first chart I showed, it's been terrible relative to historical averages. We are 17% below trend right now. And I'll actually talk about that. I'll bring it back, that chart later on. I have that organized here for that. But real quick, I want to go over another graph.
We got another chart.
Oh no, I have to use charts for the deflationist argument. It's a more complex argument. So the velocity money, we can see here again, coming down, right? It's coming down. So the velocity money, again, we can see these are, again, recessions, right? And we see a little longer history timeline. We could see here that the velocity money skyrocketed after World War II, right? Remember that World War II itself, according to McKinsey and other research, it was an era of austerity, because you had a lot of restrictions and rationing, et cetera, and you had actually a net savings. When you actually do the math, you had that net savings, which, remember, in the theory of the deflationist arguments of the different schools of economics that make them up, they would say that the austerity will lead to future growth. And this austerity led to future growth and the expelment of the debt of the past, right? So the debt was handled and absorbed by the private sector that was accumulated in the 1920s. And the 1920s led to the Great Depression, which was basically involved a lot of debt. So you can actually, again, it coincides with the arguments made. So from here, you can kind of see what occurred is the velocity money has actually been going down, and now we're even lower than World War II without actually being in another global war. So it should, I think this one should be upticking and then coming back down, but it doesn't show it there. So any questions so far before I go on to the next graph?
Nope.
So this one, everyone pointed to last year as in terms of the money printing. So here's where you can kind of dispel the idea of, this is the deflationist argument, dispel the idea of inflation because money printing. I want everyone to think of an equation in your head. All right. Think of this. It's how I try to simplify the formula, but think of it like this. 1 minus 1 is equal to 0. What does that represent? $1 created is backed by $1 in debt. 1 minus 1 is equal to 0. Once you pay back this debt, it's gone, right? So again, I'm from Venezuela. So what we did in Venezuela was 1 plus 0 equals 1. That's a lot of what we did. 1 plus 0 equals 1. We did that in bolívares. So this is the literal creation of money, what people think happens here in the United States. No. So again, like when the government is raising debt or operating QE, and the M2 money supply went up by 20%, as you can see there, did you have 20% inflation? No. Did you have anything close to 20% inflation? No. You had asset price inflation, right? Asset price inflation is a real thing. Asset price inflation can occur for different reasons. And you did have asset price inflation of greater than 20%. All right. So, but that's another topic. That's another topic. What I want to show here is the deflationist argument. They'll use this and they'll say the M2 money stock, the 8% annual change, 20% rise, but we didn't have nearly that level in consumer price inflation, right? Your average goods did not go up by 20%. Okay. So this can kind of cause some, going back to this, the velocity of the four major markets. So China's in here as well, so we can actually look at China, but basically this is a negative trends. Remember, we want the velocity of money to be going up or staying the same, relatively stable. We do not want to see this decrease. This decrease can be quite bad. This is the amount of times the money is exchanging hands. And United States is very close to going below 1, which is not good. It's not good. So going back to graph 1, and I'll make this last point. We're basically done with the deflationist argument. For those of you stuck through the whole thing. Graph 1, I'll point to one more problem that can occur. And this is a trend that you can actually, a lot of studies have found, is that when you go below trend, and as the gap below trend widens, the discrepancy between high income earners and low income earners widens as well, which is quite interesting. Drastically. And you can kind of maybe say a lot of people are complaining about that today. And it's because of the, again, we're adding everything together all at once from what we've discussed. Remember, malinvestment. So malinvestment or unproductive debt, malinvestment in the form of fiscal policy, and then unproductive debt in the form of taking on the debt. So a lot of debt or a lot of spending, if it's not directed efficiently, and by the way, the government is notorious for not being able to do such a thing because the incentives aren't there. Remember Charlie Munger's quote, "Show me the incentives and I'll show you the outcome." Government doesn't have the incentive of using debt efficiently or productively. They don't have those incentives. So Austin and I, for example, we have the incentive allocating capital efficiently. All of you watching have the incentive of efficient capital allocation, because if you do, you will generate what's known as value, economic value. Okay, so that's your incentive to do so. Government has no incentive to do so. They don't have an incentive to produce economic value per se, because they are essentially a monopoly, right? Monopolies in economics don't tend to, or hardcore monopolies don't tend to care about being the most efficient possible, because they're the only player in town. So that's something you can kind of think about. And when the spending is mal spent, it tends to trickle into the places, obviously it wasn't necessarily intended to, and it always will. There's nothing you can even do that by definition of malinvestment. And the government, again, is not incentivized to invest wisely. It just isn't. So the last point of the deflationists is this all is concurrent with current Federal Reserve limitations. What do they mean by that? Many of you probably have heard of the central bank digital currency. Have you heard about that, Austin?
I actually have not heard of that. No.
So the central bank digital currency is, in simplest terms, a cryptocurrency made by the central bank, where it is programmable currency. So think of the crypto dollar. All the deflationists kind of agree. The creation of the crypto dollar changes the game because it basically enables you to have accounts at the Fed. So currently you can't have a bank account at the Fed. You have no relationship with the Federal Reserve. The creation of such currency would enable this relationship, and this would cause hyperinflation. That's pretty much across the board. All the deflationists agree with that sentiment. The creation of the central bank digital currency would cause hyperinflation because it does change the rules. All of their theory has been based on current rules, current Federal Reserve Charter. So an example, again, they would not have stood this or attested to this theory in an environment like Venezuela, where the rules were different, right? The rules of the financial system was very different. The government had different kinds of powers, a lot more power than the government of the United States to do certain things. And so the currency, remember, everything is relative. The currency of Venezuela being the representation of the economic output of Venezuela and the backing of the Venezuelan government was essentially destroyed by its own government. So with that, I think it's a good segue into a very brief explanation of modern monetary theory. We have left the complicated stuff, going back to the less complicated stuff and the grade school thing. I'm kidding. The very modern, not new theory of modern monetary theory. So, Austin, to kind of quickly go over modern monetary theory, what do you think it is? You can say, I don't know.
I don't know.
Okay. I don't know. Okay. So I don't know is maybe what a lot of people think. They might have heard it on TV or something like that, but they haven't really gone into it. And this is actually important because a lot of people in power today actually believe in this economic theory or this economic model. So it may or may not affect your life. So modern monetary theory, the deflationists probably hate these people. Okay. The inflationists hate them for sure, but the deflationists probably hate them a little bit more. Because remember all the arguments I made in the deflationist argument, a lot of them said that the debt is the problem. The debt is the problem, the debt is the problem. And they agree with the inflation on it. They just disagree on the nature of the effects of the debt, right? So MMT basically says government is not a household. It begins with that. Government is not a household. So when you, Austin, you're a household. So you have a limit on how much debt you can take. You have an income and then a limit on debt. Well, they say, take that idea and throw it in the trash when it comes to government. Government is not a household, right? So that follows into the next point. Debt is not a problem. Debt is not a problem. And they advocate for changing, a lot of times they advocate for changing the Federal Reserve powers or the powers of government in regards to the limitations they have on the effects or what the Federal Reserve can do. Question, go.
So what's the rationale behind them saying debt is not a problem after everything that you just showed us with all these copious amounts of charts and everything? Like, we've seen that it definitely is a problem. So how does this theory come to terms with that? Or is there maybe even an element of almost willful ignorance with this? And that's why the inflationist and deflationist parties hate MMT so much.
Well, I will remember, I'm going to argue their side, so I'm not taking any sides, but I'm going to be an MMT guy right now, and I'm going to convince you that MMT is correct. So
fun. Let's do this.
I will just point to here. I just put this in the sheet that I'm going to use later for the tax data to kind of dispel some tax myths, but for now, I'll use it for this. So GDP in simplest terms is basically this formula right here. GDP is a function of consumption plus investment plus government spending. There you go, right there. Government spending. Government spending. And then plus exports minus imports. So GDP being a function of all this, MMT will say you're increasing government spending. Government spending increases GDP, right? Right?
Now I get it. Okay. Yeah.
So that's basically where we're going with this. So in order to reap greater economic benefits, we increase government spending, we pump more money into the economy where we want to focus, and it basically marries fiscal and monetary policy. And that's what basically modern monetary theory is. Yes.
But that's still, it's like a reclassification of a definition, but it's still ignoring the consequences of such input of into the economy, if I'm making sense with what I'm saying. Because we've seen the data is showing us that there are legitimate consequences to doing these sorts of things.
Oh,
so again, yes.
What they argue is I am the modern monetary theorist right now, so I'm going to pretend I am. So what we argue is the debt problem actually stems from the private sector debt problem, not the government sector. So we need to worry about private sector debt, but not government sector debt. Government can borrow infinitely. And it's the private sector you actually want to be careful with what they're borrowing, because basically you can't go bankrupt in your own currency, as the theory goes. I cannot go bankrupt because I'm the creator of the currency. However, that ignores that the US government doesn't create the currency. But that is what the theory states. And GDP will grow with government spending. And as long as I am increasing GDP, tax income is a function of GDP, which I'll show in the tax data chart, which is actually quite important, because if you leave this video with anything, I think you'll find this data point the most interesting, which we'll get to very shortly. But that's basically what I'm going to use. And this example of subway tickets, right? This is often used by the creators of MMT as an example. So what is a subway ticket?
I mean,
It's a subway ticket.
It's a ticket to ride the subway. Yeah,
Exactly.
It's
So
a subway ticket.
it's a form of currency. The ticket itself is a currency. So
It is, yeah,
I
because
can
you're
give
exchanging it for a good,
exactly.
and or a service. You're in this sense, you're exchanging it for a service. So
Exactly. And the government can, or this local government can create as many tickets as it wants. Correct?
because it's backed by the promise of a service.
And then
itself.
it can fluctuate, or and people, then someone will say, okay, but if it gives everyone a ticket, it will flood the subway system.
And also, like, the value of the ticket is tied to the future promise of providing a service. If you're
Yep.
not going to provide the subway service, the ticket is worthless.
Yep.
So
And then, so here's what they'll respond to. So the service is done. Yeah. So what happens if everyone wants to go use the subway now, because it's free tickets? Everyone gets a ticket. So this is where actually modern monetary theorists think taxes are for it. The argument is taxes is actually useless. The government doesn't actually need taxes to fund itself, right? What taxes are is creation of demand for the money. So an example, Austin, you own a home. I'm the government. Remember, property taxes is basically rent to the government. You are renting the land from the government. In the United States, you don't really own the land in a lot of ways. Because if you want to do this, experiment, don't do this experiment. You'll lose your house. But if you do this experiment and you say, I'm not going to pay my property taxes, well, you're going to be evicted by your landlord, the government. So the government's going to evict you from your home and then go sell it on a tax. But this is not that kind of video. But you're going to basically lose your house. So what this does is create demand for dollars, right? Now you have a demand for dollars. Why do you need dollars? Because you need to pay your tax bill. You see, you have a fixed tax bill on your property. Well, it's not fixed, it's a percentage terms of the value that they appraise, by the way. The government appraises your property and tells you what the value of your property is. Of course, there's there's an intuitiveness to it, but anyways, the point is it's creating demand for dollars. So now, Austin, you have to go out there and work for some dollars. You got to go get these subway tickets, right? So that's how they're explaining the system. Remember, all these three systems that we kind of went over today are different explanations for the same system, different viewpoints. So MMT takes it from this approach and says the government can borrow infinitely. It's not the problem on the government sector, it's the problem on the private sector. You don't want excessive private sector debt. You want the private sector to borrow when necessary and not borrow when necessary, and kind of like an even sense. But you don't want to limit the government. You want to, yes?
my question is, you want the private sector to borrow when necessary and
Yes.
not to when not necessary.
Yes.
In that instance, then the government would be defining what is necessary and not necessary.
Yes. You're kind of getting to the point where MMT is a lot of central planning.
Okay.
Oh, yes.
So that makes sense to me.
Yes. Yeah. So MMT is a centralized system. It's a centralized system. So those of you who are completely against that are probably, not liking MMT so far. And don't worry, a lot of people don't like MMT. So yeah, MMT is a centralized system, and it derives its theory based off of the idea that the system itself can be managed by a group of individuals at a centralized authority. So it does assume that fiscal and monetary policy can be married together and, in a sense, be directed to be more efficient. So modern monetary theorists, you'll hear a lot of them argue, and I think one of the most prominent modern monetary theorists was on the Bernie Sanders campaign as an economic advisor. So they'll use a lot of rhetoric in terms of like that the current fiscal spending and monetary policy it disproportionately affects the upper class, blah, 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 blah. And remember, the deflationists will say, well, of course, because it is by definition unproductive debt. Unproductive debt will always benefit the asset holders or those who produce the most value. Kind of like a Pareto's distribution, right? And if those of you who are math whizzes, you probably know what a Pareto's distribution is. If you don't, you should probably go look it up. And the interesting phenomena of the Pareto's distribution. Remember, separate the distinction between phenomena and theory. Okay, Pareto's distribution is more of a phenomena. So in line with Pareto's distribution, the unproductive debt will benefit the most productive individuals of the society. greater than those who are the least productive. So again, I said taxes and forced demand. Yeah, and taxes don't actually matter. So that's the breakdown of modern monetary theory. So now we're done with that, the organization of that. We're going to go into
The bonus part of the video.
well, before we go into the bonus part, which is the bonus economics section, let's go into real quick this part, because I think a lot of people will appreciate this analysis on the data, on tax data. And this is actually all from the Federal Reserve, and it's all organized. I'm sharing it right now. So basically what you can kind of see here, remember that GDP is a function of government spending. So what I'll summarize here in quick terms, that taxes is basically a function of GDP size. So you can see here outlays of GDP, outlays is spending, receipts is income from the taxes. So taxes as a percentage of GDP has remained about the same forever. And you can see what happened here is World War II, Great Depression, the inability of the government to collect taxes from the economy because of a great problem, a great recession, a Great Depression. And you can see here during the Great Recession, you also had a decline. In the year 2000, you also had a decline. So you can kind of see here when bad things happen in the economy, the government is not able to collect as much. And if I were to map out 2020, ignore this because these were projections by the Fed that are no longer accurate. 2020, if I were to map it out, you would see another big dip. Okay. So from what you can see here, the government has averaged a recipient or receipt of 16.8% of GDP. So 16.87% of GDP over time, regardless of the top tax rate, corporate tax rate. It really doesn't matter. It's actually taxes are kind of a function of GDP, of economic size, which kind of makes sense. And when you realize this, you start to understand that what government actually needs to do in order to reasonably pay off the debt is increase the economy or grow the economy. Now that seems super easy, right? Just by saying that, oh yeah, let's just increase the economy. Now, what is a huge function of GDP? Government spending. So if you decrease government spending, right, to kind of let the economy or let the taxes catch up, you hurt GDP. And if you hurt GDP, you hurt the function of tax income, right? You hurt the part of tax income because tax income will be, relatively the same, around 16.7. And I think I mapped out the, it's about like a high of 20% and a low, if you ignore the World War II and Great Depression, 15%. So let's assume 15%, but if you're even being conservative in that measure, this is actually concerning thought. You should really be kind of concerned about this in the argument of the US ability to pay down the debt, because if they lower government spending to allow it to catch up, you're also going to be lowering the income. So it's kind of counterintuitive, but the deflationist will say, hey, longer term, it's beneficial austerity. But the thing is, it's not politically viable to do austerity. So therefore, you're in a trap. So you have to assume that we're not going to do austerity. So if we're not going to do austerity, why does this matter to you as an investor? Well, you actually have to follow where power will actually shift. Basically, if you come to terms with that the United States probably won't make good decisions, you have to then adapt. And if you don't adapt, you will suffer the consequences. But adapt, hedge your bets, basically to preserve your wealth. So following this out, you can kind of model this out, and based on current trends, the government will basically reach a point where its servicing of debt will equal or exceed its tax income. And again, tax income being a function of GDP, right? So you just model out GDP growth in about 40 years. Those numbers will equalize, and that's not good. That would be basically I think that would be like the point where in which you can literally say the government is defaulting. So unless things change up at that point, but that's the current trend line of growth rate of GDP, and then current trend line of debt growth, excluding the anomaly of 2020. So you can exclude that, and you'll get about 40 years from now. that will be around the case. So, but things can change. So many factors can change between now and then. So like they can improve certain things. The economy can just grow all of a sudden for whatever reason. We could have a new industrial era, an industrial boom in some capacity, like a new industrial revolution. But that's just current trend lines. So, and then that would kind of coincide with the shift of power into the East. Okay, so the shift of power from the United States to the East, simply put. And then the loss of the world reserve currency status would happen at some point during that time, in which case you may or may not want to exit or hedge your bets against the dollar if your wealth is predominantly dollars. All right, so that's kind of like a big overview of macro and how it might affect your investing. So to summarize, inflationary argument, if you believe that, you want to focus on assets that do not do poorly during inflationary spikes. If you're a deflationist and you agree with that camp, then you want to basically not panic about inflation and actually, well, again, a lot of deflationists believe short-term deflation, long-term hyperinflation or inflation. But you would want to kind of play around those camps and position yourself well for the potentially high levels of inflation that follow. And then if you're a part of the MMT camp, don't worry about any of this. The debt's not a problem. And it won't even matter when you model out the 40-year time period where the US government is spending more money servicing the debt than it is spending money on the traditional spending stuff, and has to borrow all the money to even service its existing debt. So those are kind of the three camps. And if you followed up to here, we're done with the 3 points. Now we're just moving on to bonus content. So the bonus content, first I'll go over some interesting stock plays that we did last year. So should I talk about them? I feel like some people might find it controversial.
I mean, you might as well. You did it, so
yeah.
Might as well.
Okay. So last year around November 3rd, the United States had an election, and there were two parties that were viable for winning. And so one of the just to keep it like that, one of the individuals was intuitively, for I guess normal individuals, you see, I'm wording it this way because I don't want to offend people. Because I know people get heated by this.
But I mean, this isn't an area where you could offend someone. You're legitimately stating objective facts about what happened in accordance to your investment you made.
Yeah.
Dude, nobody's going to get offended over this,
Okay. So in that note, if the Biden administration had won the election, I had an investment plan that I did execute because he won, which was basically investing in large oil companies. And it played out quite well, more than I thought possible. The two that I played was a Russian gas company, Gazprom, and ConocoPhillips. And I did own Occidental Petroleum for a bit. I actually sold that one too early. And then poured the proceeds into ConocoPhillips, and it would have been better if I actually did the opposite. But here or there, the positions have done really well. I'm up easily over 100% on both. I think both are above 150%. But basically, the thesis was derived from the understanding that a lot of these companies, they offer a product that has inelastic demand, meaning it doesn't matter what you personally believe about their product. You are utilizing their product. And if the price of their product goes up, you will continue to buy it.
You have to. Yeah.
You have to buy it. You have
to. Yeah.
Yes. So these companies understand this. The large companies understand this. They have production diversification across the entire globe. And by them understanding this, there's only, if you put on your consulting hat and you were to advise these companies, what is a way for you to increase profit margins? The only power you have as this industry, because it's a commodity-based industry, is to constrict supply. That is the only way you can do this. That's the only way you can benefit. So with that being said, the administration that was intuitively the bad one for oil was the best one for oil, specifically big oil. So the investment thesis was, if the Biden administration had won the election, to invest heavily into oil companies. And it turned out to be correct, because a lot of factors from there contributed to supply constraints within the United States regarding energy. Whether or not you agree with that or not, that's simply what did occur. And then you may have different facts, but that's why investing is interesting, because we can invest on our facts and see who came out to be true. So awesome.
So just speaking of objective fact here,
Mhm.
if I'm understanding what you're saying, kind of where the logic is going, if they're a commodity business,
Yes.
they need to increase their profits. What they're going to do is ally themselves with the party that have all of these environmental campaigns, and they want to improve the environment and so forth. And then by doing this,
that's the 4D chess. That's the 4D chess level. We're not talking about that one.
no. But then by doing this,
Mm.
what actually happens is it could turn consumer sentiment against it, therefore introducing laws and policies that would in essence constrict supply, and then raises the profit margins.
Yep.
That is some pretty high quality 4D chess. This is objective fact. Yeah.
Okay, that part is 4D,
objective fact. You know, I've not given an opinion at all. This is objective fact. So that's really interesting when you start getting into kind of what you think might be true, what morals you're holding about these sorts of things. But anyways, yes.
What I'll say to that is, if you have heated opinions about, I think politics in the sense of investing can be very detrimental, because it will cloud your judgment and you'll form a sense of tribe. And if you do that, you're going to view the world in the sense of your tribe and ignore facts that counter your tribe. If you do that, and you may be watching this video and for all intents and purposes being triggered by the statement that Biden was good for the large oil companies, if that triggers you, and if the same with the other side, okay, but like, let's keep it to this side for now, because it's the real life example right now, because he's the current one in power. So if you do that, you're going to miss out on a lot of opportunities, because you're going to ignore the opportunities that are presented, because you're just going to accept what is, I guess, intuitive to yourself. Right? It may not be intuitive to the other
preconceived
people.
notions.
Yeah, preconceived notions, exactly. So you may be falling into the trap of preconceived notions. So my point with all that was, the investment was kind of like not a double-edged sword, but kind of filled two different avenues. It was a commodity-based business, which protected my portfolio from potential inflation. Then on top of that, we didn't see the hyperinflation or anything like that, but we did see supply constraints in the form of energy, and that was fantastic. You could not have asked for more. And on top of that, the administration did approve early on the Nord Stream 2, which was another boost to my Gazprom investment. Now he's doing some things against Russia, but the point is, he basically gave Gazprom Nord Stream 2. So the previous administration was kind of blocking Nord Stream 2, which would have basically allowed Russia to sell more natural gas to Germany. And the new administration was like the icing on top for my investment, basically allowed it. And I'm going to probably continue holding Gazprom for the foreseeable future. If anything changes, I might mention it, but don't invest in Gazprom. That one's a little bit more homework, necessary.
But I kind of find this entire conversation really interesting, because you're talking about not investing with preconceived notions.
Oh yeah,
I think that's so integrally
probably needs its own video. It probably needs its own video.
Yes. Oh yeah, and I think that's so, just kind of before we move on to the bonus part of this video, I think that's such an important thing to bear in mind when you're looking at investing. You need to stay objective, basically, because, and then also too, question what you might think to be conventional wisdom.
Oh yes,
being completely honest with you, because like a lot of people will hold opinions of what they believe to be fact, and it's devoid of about 95% of the answer. But the only way we can really determine these things is if we look inwards and realize oh shoot, I'm missing 95% of the answer.
Yeah,
You know,
I'm always like wanting to find individuals who disagree, because if they disagree, maybe potentially or highly probable, they may have the answer that I'm missing, or pieces of to the answer that I'm missing. And I can kind of listen to them and then take those pieces and kind of put things together. So
yeah,
uh, I I mean, a lot of that thesis was involved with like the backing and basically a lot of the, macro investment logic, because you think macro investment, oh, what macro investing, oh, how is that ever gonna be important in my investing strategy, or micro investing? Well, economics did play a role, because I understood that oil is an inelastic good, and regardless of whatever you believe, you're going to need to use some of its products in some form or another. So the only way that these businesses are going to profit heavily is if we can stop the supply somehow. And what better way to stop supply than an individual coming to power that would be intuitively bad for them, but in a literal sense, very good for them. So
yeah.
that's the end of bonus content 1, and bonus content 2 is potentially the most controversial, but
Say it. Let's do it.
it's the last economic theory that we'll go over, which is more of like it's separate from the previous ones, because all the previous ones are based off of market forces. Then the last one is the one that is pertinent to your investing, because you want to watch out for it. It is the expropriation of private property, or socialism. So socialism defined under Marx and Hegel's points of view. I know that,
which this is incredibly important. This is
yeah,
incredibly important.
because the whole socialist community have there is no true Scotsman fallacy going on, where every socialist is saying that the other socialist is not a real socialist, so everyone's pointing the finger and saying that's not a real socialist. So we're going from the classical definition of socialism as the transitionary point between socialism and communism being a form of anarchy, a theoretical form of anarchy, where there is no government currency and everyone is equal, blah, 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 blah. But going off of socialism, why is that important? You want to pay attention to the areas or jurisdictions you're investing in, because if they inch closer towards that stylistic form of governing, it could severely destroy the value of your investment. Because the whole Austin.
No, go.
Well,
yeah.
The whole philosophy behind that is the expropriation of private property, because the private property is in the literature inherently the problem. And you owning this property, aka your stock investments, your bond investments, anything, they separate personal property versus private property. Okay, so let me try to be as all encompassing as possible to cover as many points. But the point is, your investments in such jurisdictions can be at grave risk. So, like for example, Venezuela, where I came from, if you knew the politics of it, it was a socialistic regime from Hugo Chavez, and then he basically went against the institutional idea of owning private property, and he expropriated tons of private businesses and private property in terms of homes, apartment buildings, etc. He was famous for going around, and the TV cameras would follow him, and he'd be like, "Oh, what does this building do?" Of course in Spanish, and then the people would say, "Oh, that's a blah blah blah, that's a factory." He's like, "Expropriate it," and then immediately the military would come in, take it over, stuff like that, and then he'd redistribute it to the masses in theory, and then a lot of the farming production, etc. But the point with that is, that's the final bonus economic theory. You want to pay close attention to the direction of the government that you're investing in. They may not be socialistic now, but are they trending towards that? You got, for example, I'm calling out Latin America here. You want to be very careful with Latin America. Latin America is kind of like, a toss up in some instances. And you want to be careful for the socialists who are socialists, but in fact are corporatists. So then those will be a little bit better for you to invest in, because they don't actually believe in the dispelment of private property. They don't even believe in the seizing of private property. So they're still going to be markets, or viable markets, but you do want to just be careful. So for example, the close one you want to keep an eye on is Brazil. well, in the theme of this political philosophy, I'll quote Lenin: "You may not care for politics, but politics will care about you." So, in the case, like if you had, for example, your life savings in Brazil, and you know that the favorite to win, according to the polls, or some polls at least, is Lula, and Lula is part of the PT party, and the PT party is essentially the Workers' Party or the Socialist Party. It's not the literal Socialist Party, but it leans in that realm, or heavily leans in that realm.
Yeah.
You do want to be cognizant of that if you're going to keep your capital in Brazil, right? So United States is not anywhere close to such a scenario occurring, but always pay attention to that. That's kind of like my last theory. So macro, how does it affect your investment? We went over the inflationist argument, the deflationist argument, the MMT argument, and the bonus content.
Explored taxes, we explored some investments we made, and then we even explored a little bit of the risks with socialism itself. So
yes. So again, defined in the classical sense of socialism versus in communism, because some people for some reason define socialism as like Sweden, when they're like potentially the most capitalist country on earth, or one of them.
That's funny.
Where everything's privatized, or when a lot of things are privatized. So that's basically it.
Yeah, I really found interesting today, just kind of learning about really the plumbing of the way money works in the economy. Now, if this is overwhelming to you guys,
oh, well,
full disclosure, it's overwhelming to me. It's not something that you can really just get in one sitting. However, we really hope this video acts as sort of a guide that you guys can keep revisiting when you have other questions, and hopefully we've been able to answer those questions. Do you have any closing thoughts? Yes.
I imagine there may be some questions in the comments section, if there are, because it is a long video, so maybe not everyone got to the end, but that's completely fine. Everyone has things to do during the day. This is just there for educational purposes, but I didn't cover everything. I know I missed a lot in the three different philosophies, but this is not going to be an 8-hour video. So if you notice that I missed some things, feel completely free to add it in the comments section so that others can read from it, and then I'll comment on it too, and share my thoughts. And then because in each camp there are tons of different perspectives that I did not cover, and I wasn't trying to take a side. I was just trying to emulate the perspectives as best I could, and not kind of tell you what to think, but kind of just throw them there, and you think whatever you want to think. But if you want to add to any of those, just add it down in the comment section below, because I think people who read the comments will love to see that value added.
Oh yeah. Yeah, well, this is the Capital Mindset Show. This is probably our longest, most comprehensive, most educative video we have ever put out about a particular topic. We really hope that you guys have enjoyed what you've seen here today. If you have, please be sure to like, comment, and subscribe. Also share the video. It really, really helps out the channel if you like what you've seen. We're your hosts, Austin and Fabio, and we look forward to seeing you guys again. Take care.